Hello my fellow freedom builders, and welcome back to yet another quick video about 4 rock solid stocks that I have found for you. And as I did yesterday where I took the first 4 of them, I will go through them with my trading view technical analysis here. I'll look at the Stockopedia where we take a look at some of the fundamentals, and we're going to look at Fast Graph where we are seeing if they are under or overvalued. So as I mentioned yesterday, we are getting close to the 5,000 subscribers, and that means it is important for you to subscribe to the channel and to like and comment, because I am doing some competitions. I'm doing some giveaways for some of the subscribers that leaves comments and likes. So please hit all the buttons you can find down there, and let's get on with the show for today. We're going to have a look at 4 stocks: BorgWarner, HanesBrands, HanesBrands and Masco. Not the most well-known of stocks, but as I said in the video yesterday, this is not a video about some of these high flyers that we all know with Tesla and so on. This is a bit more conservative brands, you could say, but still stocks that many of you know. So let's have a look at the first one, BorgWarner here. As you can see, down here we are in a green zone. The RSI is above the 50 on the weekly chart, and it is in the green zone here with the relative strength also strong. One thing that many of you should notice is that these stocks that have been beaten way down here, they are disturbing the picture a little bit when we are doing our technical analysis, because normally we would say, yeah, well, there's actually a big resistance here. But a lot of this beaten down here was due to the virus crisis. So actually what I have been able to spot with many is that they were actually maybe even going down like this, and then the rest of the drop actually can be tracked back to the overall market simply dropping. And that means that this rise again here can actually be transferred a bit upwards. I know it is a bit theoretically, because of course we cannot do this, but it's just to give you a picture of that many of the technical patterns have been destroyed by the big downturn here, and therefore we might not, we should not put as much emphasis on this resistance area as we normally do. Of course, I am looking at it, and it is something we should be aware of, but right now there is a lot of movement here in BorgWarner. As you can see, it is also going up nicely, bouncing on the 20 SMA. Everything looks good on the RSI here. And if we're looking at the fundamentals, you can see that it is in a very good place. We have 77 on the quality. We actually have a 60 on the value. That is a bit extraordinary here, because then normally it's a bit lower when we find these sort of stocks. And we have the momentum at 83, giving us an overall stock rank of 91, way above the 70 that we like it to see. When we look at the PEG ratio, that is only 1, meaning that we are not paying too much for future growth. We like that to be below 2, so that is nice. Even though we are not normally looking at the valuations too much, I do like to see the EV to EBITDA here. That is very nice, 7.45, and price to free cash flow is a bit high, but that's how it is. Quality, however, is very good. The Petrosky score is 5. I do like it at 6 or above, but 5 is acceptable. And the Altman C here, the bankruptcy risk, is just moving down towards the cautious area. Let's have a look at that in a second. The earnings per share is a bit chubby. It's not the straight line that we do like to see. However, there is a good high cash flow. They're paying out a bit in dividend, 1.64%. And that dividend is quite secure. We can see here that they actually have a dividend cover of 3.7 here, and that is hovering somewhere between 3 and 6. So that means that the earnings per share can pay the dividends 3.17 times. We can also see that the free cash flow here is way higher than the dividends paid, so they don't have to go out and borrow money for just paying the dividends. The net debt here is going down very nicely, and the working capital is going up, so they have a lot of muscles to work with. The interest coverage, they can easily pay their short-term interest, and the current ratio is above the 2 that I like. We can see that the analysts are saying buy, and well, overall it is looking fairly well, I think. Good and solid company. Now, is it in a place where it can grow from? When we look at the fast graph here, we can see that we have the black line, that is the price, and then we have the growth in earnings. We have the normal P ratio here, the blue one. And what we do like to see here is that when it is oscillating around these two lines, and it is kind of here, it has been going sideways, the price. But as you can see, if you had bought in the overbought or in the expensive territory here, you would almost have ended up with a loss every single time period here. Whereas if you had bought in the cheap zone down here, there was a much better chance of actually ending up with a profit. And what we can see is that the price here tends to move up towards the lines here, meaning that if it does the same now, let's just remove this one, we actually have some very good profit on hand in the future. Now remember, these are positions that can be held for 1 or 2 or 3 or 4 years. These are not short-term swing trades. They are estimating a drop here, but if we are holding it a bit longer, we can see that were we to, let me just delete this one, were we to move up towards this point here at some point in time, we could see an annual return around 22% here, and of course there can be sold some covered calls on it to raise that. This 22.4% is including the dividends. So this one actually looks fairly well. Normally I don't choose one that has this slump here in the earnings, but it is a good and solid company, and we can catch it here in quite a cheap zone. So BorgWarner, absolutely one to watch. Next stock. Here we have the Fortune Brands Home and Security, and as you can see, this has moved way above the top here before the crisis. And when we look back, there's no obvious way that there's resistance here. You could argue that it might be a bit high and that we might want to move back towards this 72, 75 area here. That is absolutely a valid consideration here. But right now we are in a green zone. It is showing very good trend. It is keeping way above the 20 SMA here. The RSI looks good. So on the technical part, there's actually nothing really stopping us from buying it. But again, you could argue that a bit of a dip down towards the resistance here, the support here, and then a move upwards could be a bit of a better price to catch it. But that is the speculations that you need to have, because sometimes they simply just run off and there never is a retracement. So that is how it is. I am considering it right now. When we're looking at the scores here, we can see an overall stock rank at 95. We have 96 and 96 here in quality and momentum. Very nice. Just above 2 in PEG ratio. We do like it 2 or below, but 2.2 is fair enough. Value is not amazing, but we know that they hardly ever are here. We have the return on capital, equity and operating margin looking good. Petrosky scored 7. Fair amount of here the Altman C score. When we're looking at the normalized earnings per share here, we can see just the graph we want to see. It is going up in a straight line from left to right, and we can see down here the growth numbers are very stable numbers. We can see that the free cash flow is going up just like we wanted to see. They actually pay about a 1% in dividend. And as you know, I'm not normally just going for the dividends, but they are growing at a steady pace. And as you can see, the dividend cover here is way above 3. So that's just like we want it to be. Net debt is a bit high, and we can see here on the interest coverage that is only 7.6. It is fair enough, and the current ratio is 2.05, so that is also acceptable. The analysts are just hovering around between hold and buy here, so that is fair enough. When we're looking at the fast graph, we can see that we have been able to buy it in a cheap zone here for a very, very long time. And of course, you can also argue that we should have catched it here down somewhere here and made some huge returns. But what we can see is that the growth seems to continue. It's always nice when we see these estimates here, just to see the analyst scorecard, and we can see that most years it is fairly close to the same as the estimates. There have been 2 years here in 14 and 15 where they've shot below their estimates with more than 10%, but otherwise it is plus minus below 10% here, so that is fair enough. If it keeps this movement up, it might not be keeping the same rise here as we have seen, but if it just goes up somewhere to near this area up here, let's just have a look, we can look at something like 13-14% per year. So again, it's not something that'll make you a billionaire overnight, but it is good and steady performance, and of course you can also go either better or worse, that it always can. So that was Fortune Brands and Home, a good solid stock that I expect that there is some more upwards movement in, and that you can also sell some covered calls on. All right, on to the third candidate. And here we have HanesBrands, and as you can see, they have been in a very solid downwards trend. They have been before that going up from around 6 to 35 or something like that, so that's up at 5x, something like that. Then they have gone down from 34, and here you can see the power of keeping us in the green zone or red zone. We only want to invest in stocks that is in the green zone, and pretty much from around here it has been in red or yellow zone all the way down from around 30 and down to the bottom at 7. Now we never catch it at the bottom, so now we are just moving into green zone here. We are up at 16, and we are actually breaking up from this regression channel. You could argue that you wanted to see a bit more movement here, a bit of a retracement and then a movement up. That is a factor that I'm often looking at, but right now at least you can see that it is bouncing nicely on the 20 SMA, and we have the RSI above 50 here on the daily chart. So everything on the technical front is actually fairly decent here. When we're looking at the fundamentals, we can see 85, 76 on value. That is quite good. 99 at momentum and 99 at stock rank. We cannot want much better than that. You can see the PE ratio for here is 10.4. We do not have a PEG ratio, and I'm not sure. Yeah, that is because there is an estimated drop in the earnings per share next year. So of course the PEG ratio will turn out as not there. But they are expecting in 21 to go up again. And I suspect that this, of course, has something to do with the virus crisis we are seeing right now. Free cash flow is going up just like we wanted to see. They are paying a dividend of 3.7%, which is actually very good here. And they do have a dividend cover of 2.4, 2.7, so on. So there should be a good cushion here, a good buffer here, so that this dividend should not be in danger just right away. You can see the cash flow, $2.10, and dividend only 60 cents. So there is enough of, they are only paying out somewhere between a third and a fourth of the free cash flow in dividends. That is what I like to see. Net debt is fairly stable. We can see the interest coverage is quite low here, and that is something I would have to look a bit more into, but the current ratio is just above 2, and that is at least the minimum I would want it to see. The analysts have gone from just around hold to a bit more over into buy for the last the period of time here. And when we look at the HanesBrands here in the fast graph, we can see this is the decline in the stock. And you could argue that, yeah, well, it's not always a good thing to buy the stock when it is in the cheap zone, because you can still lose money. And of course you can. It is not a guaranteed profit here. But then again, we are not just investing from the fast graph. We are combining it with all the other stuff. And what we can see right now is that they have been in a decline here, but the estimates are that they will be going up again. And if they do, and they move up over the next couple of years towards something like the orange line here, we will be able to see just below 30% per year in the HanesBrands here, and that is of course also included dividends. So that is actually very good and fairly stable. I think they can be moving up here, maybe even further up. We often see that we go from a way too cheap, a value stock, and then keep going up here. And of course we should not just sell because it is up here. We want to see the sell signal first. It comes around here. So that was the third candidate, and we will move on to the last one of the video today. And that is Masco Corp. As we can see, they have also had a very nice run up here from the bottom, and again you could argue that you would want to see it down towards the support here, maybe down around 50, 52, somewhere down here, and that would be a drop of 8, 10, 12%. You could easily argue about that, but you could also argue that you want to take it here in the trend because it seems to keep going up here. So that is entirely up to you. I'm not giving you any investment advice here. This is only some inspiration from my desk here, the things I am considering. Looking at the Masco here, we can see we have a 96, 94, 95 in the ranks here. Very nice. We have a PEG ratio at 1.9, so it is below the 2 that we like to see. We can see that the return on capital operating margin is very nice. Earnings per share growth here, earnings per share normalized is going up, just like we want to see it here, with some nice growth numbers, some very good numbers here in 2018, but that was after a drop. But then in a very stable level here, we have the free cash flow is going up nicely as well. We have a dividend of just around 0.9%. That is not crazy high, but it is with a huge dividend cover of above 4. So it should be very stable, and it is also going up. And as we can see, the free cash flow 2.8, dividend only 0.5. So there is a lot of room here. The net debt has been dropping a bit. Working capital is fairly stable. We have an interest coverage of 7.5. That's okay. The current ratio is only 1.5, and I would have to dive a bit more into that because before I threw my money at that, because normally I do like that to be 2 or above. We can see that the analysts are they agree quite a lot here at buy, tilting towards a strong buy. And yeah, again, a fairly stable and good and solid candidate here. Looking at the fast graph, we can see that it has been running in a cheap zone for quite a while, and almost no matter when you would have bought here, you would actually end up with a profit because you are buying into a stock where the price has gone up less than the earnings have. They had a single year with a drop here, but as we can see, if we want to go from here and over the next couple of years have a price moving up towards the orange brownish line here, which is the development in the earnings, we can see a total annual return of around 23%, including dividends. So that is also a candidate where you could actually have even a drop in the earnings here, and you would still have some room to move and to move upwards. So that is what we are looking for, the good candidates with good solid fundamentals, good growth in earnings. We want to see the good technical part play out, and we want to see all of this from a quote-unquote cheap zone down here compared to the earnings development. That's all for today. Remember to subscribe and like and comment the video so you can be a participant in this little giveaway competition that I will be telling you more about very shortly. Take care of yourself and your money out there, and I'll talk to you again very soon. Bye.